Hey friend, Steve here. This is boring, but it builds wealth quietly, consistently, and for generations. Whole life insurance is not flashy, but it is one of the #1 assets that the wealthy always own. I've seen the top 1% grow their money with this product, and most people online are not talking about it. So in this video, I'm going to break down the 7 steps to use whole life insurance exactly like the rich do, even if you're starting from scratch. First, let's start with what whole life insurance really is and why the wealthy are obsessed with it. Someone I know who has worked for some of the top investment banks in the world started 2 whole life insurance policies with our company last year. He analyzed the product, different insurance companies, and really understood how the cash value works. After learning about the product, he said it's a crime that more people don't understand how this product really works. So let's start with the very basics. A whole life insurance policy is a life insurance policy that lasts for your whole life, unlike term life insurance, which expires at the end of a term. For example, if you have a term life insurance policy that is a $1 million policy with a 20-year term, that means that after 20 years, the policy will expire. And if you want to keep your coverage intact, you would have to buy a new term life insurance policy, whereas whole life lasts forever. Here's how it works. You've got a few components here, and what we'll start with is our fancy chart. So the first thing we have is money we pay in. So this is called your premium. There's also another area that you can put money, which we'll talk about later. So the premium with a life insurance policy is level for your whole life, meaning whatever that premium is, it is guaranteed not to increase over time. How long do you think you have to pay a premium with a whole life insurance policy? A lot of times people think, my whole life. However, that's not the case. You can stop after 2 years, 5 years, or you could fund it up until age 65. There's a lot of different ways you can set these policies up. But the premium is how I pay money into the policy. Next, we have our actual life insurance. This is called the death benefit. Why it's called the death benefit is because a very large monetary benefit is paid out upon our death. Now, the death benefit of a whole life insurance policy will start high. You'll also see it gradually increase over time. And when we die, the death benefit is paid out 100% income tax-free to whoever our beneficiary is. And then we've got the piece everyone's always interested in, the cash value. So what you'll notice when you look at the cash value of a whole life insurance policy is that if it's set up right, you'll have a lot up front and it will go nowhere but up over time. Now, the death benefit will always be higher than the cash value, but you'll see them both grow together over time. And again, it goes nowhere but up as the years pass. So most people that our company works with who open whole life insurance policies and put a lot of money into the product often say, I don't care about the death benefit. I'm only interested in the cash value. Why would someone say this? And why would anyone buy a life insurance policy if they don't care about the life insurance? Might not make sense. It's because of what the cash value provides. When you look at the cash value of a whole life insurance policy, there are several benefits. Here are the 3 main benefits. First, you can access your money anytime you want, and there's no penalties for accessing it. Second, it grows safely. Specifically, there's no stock market exposure or risk. If the market tanks, you'll see your cash value continue to go up. And then third, it's tax-free as long as we follow IRS rules. There are a lot of different ways in which you can actually save money with a whole life insurance policy. I'll give you 3 quick ones. The first is someone who says, I'd like to consistently add money to this policy every year. I might want to pay $500 per month until I am 65 years old. Okay, that's very common. This is the classic cash flow approach. The second example might be someone who says, I want to put a lot of money in, say it's $100,000 per year for a period of 10 years, which would get a total of $1 million into the policy. So they're putting a lot of money here, usually with the intention of accessing that cash value, either for income during retirement, for opportunities, or anything. And then third is someone who has a lump sum of money and they say, I want to get this into the policy in a very short period of time. For example, I might have $1 million sitting in the bank, not earning much interest. I like the benefits that this product offers. How do I get it into the policy quickly? But I'm not into the idea of paying premiums forever. I don't want to do that. The thing is, regardless of which example you choose or what your approach is, what you'll find is that the cash value will continue to grow without any risk. If it's set up with the right company and truly set up for high cash value, the growth rate is usually somewhere between 4 to 5%. This is what we've seen with clients that we've put in place for our clients. And it's also tax-free, provided we follow IRS rules. Let's talk about how you can use the product while you are still alive. Accessing the cash value in a whole life insurance policy is a lot like accessing equity in a property that you own. So if you're not familiar with how real estate works, here's a quick example. Let's pretend that you buy your dream home and it's worth $1 million. So here you've got your home. The value is $1 million. All right, cool. So this is you living in the home. You're all happy. Woohoo! Now, aside from being a very nice place, we're going to pretend that this property appreciates by 5%, which is $50,000 per year. I'm just going to use a flat 50. We're not going to pretend it's compounding. Let's keep this simple. So what this means, you own a property, it's worth $1 million. The fair market value, which means if you sell the home, you get that dollar amount, is going to be that $1 million plus $50,000 every year. We're assuming that the property is going to go up in value. So what this means is the first year, it's worth $1 million. The second year, it's worth $1,050,000. And if we go to the 10th year, if we just get $50,000 in growth or appreciation every year, it would be worth $1.5 million. So the value of your real estate continues to go up every year, which continues to add to that smile that you have. So if you said, hey, I'd like to take a loan against this property for $500,000, what you could do is go to the bank and say, I've got this property that's worth $1 million today. They will most likely give you a $500,000 loan. So you go to the bank, they give you $500,000 loan. Now there is a cost to acquire that loan from them, so you are going to have to pay them back with interest. Let's pretend, for the sake of simplicity, they charge you 5% interest. So getting that 500 grand, if it costs 5%, that means you're paying them 5%. So as you pay it back, 5% goes to the bank. Here's the question if you're new to real estate. Do you still get that $50,000 of appreciation every year on your full property value of $1 million? Or do you only get it on half of the value because you have a $500,000 loan outstanding? The answer is you still get that $50,000 of appreciation on the entire property value. The value of your home continues to appreciate at the same rate, regardless if a loan is outstanding or not. So using a cash value life insurance policy works almost the exact same way. So let's pretend you've got a whole life insurance policy, and we'll just say that your cash value is worth the exact same dollar amount. So you've got cash value of $1 million. We're going to pretend instead of owning that dream home, you have a whole life insurance policy with $1 million of cash value. So the growth rate on that might be around 5% per year, which would come out to what? $50,000. If you said, I see an opportunity over here, I need some money, I'm going to take a loan against my life insurance policy in the amount of $500,000. Whatever you have in cash value, you can access through a policy loan. The most you can typically borrow against a life insurance policy is about 95% of whatever your cash value is. So in this example, we're going to take a policy loan for $50,000. There will be a cost. You'll find rates are right around 5 to 6%. There's a lot of companies that have fixed loan interest rates of 5%. So that means 5% of $250,000 is $25,000. That is interest that you're paying to the insurance company. So yes, you do pay interest to the insurance company on money that you borrow from your life insurance policy. Does that make it a bad place to put money or bad place to access money from? No, because what happens with that 5% or 50 grand that you're earning? Well, even though you've taken a $500,000 loan, you still get that $50,000 on the full $1 million cash value, meaning you're receiving constant compounding. So if I just isolate the net results for 1 year, I earned 50, I paid 25, which leaves me with a spread of what? $25,000. Now it can be negative And you'll see that in the early years of a whole life insurance policy. But if you do it right, you can get over those negative years very, very quickly. And it does get better and better with time. A lot of people will do this, but often they'll take it a step further. Let me give you an example of this. Let's pretend that someone wants to use their whole life insurance policy to buy an investment property down here that is producing 10%. And we'll assume that the cost to acquire this property is $500,000, which would produce at 10%, $50,000 per year in investment income. So I've got my life insurance policy up top. I took my $500,000 to acquire the property. Now, when I look at the returns, so on the real estate, I am earning what? 10% of 500 grand is $50,000 per year. So if I look at the net results here, what happened? Well, I earned 50 grand on the policy. I paid 25,000 to the insurance company, but then I also earned 50,000 on my real estate. So the life insurance spread, 25K, plus the 50 gives me what? 75K. Now again, this assumes I've got a seasoned policy that's producing high returns. If you check out some of our case studies that really break down how real estate investors use whole life insurance, you'll find that the spread does not always look as good as what I'm showing you here. Sometimes it does. Sometimes it looks even better than this. But during the early years of a policy, I've got a negative spread up here. Like you're going to see that it's not always looking all cupcakes and rainbows. Sometimes it is going to sting a little bit. The thing is, people will leverage this product for other opportunities. So here's how you can do what we just went over. Step one, get a whole life insurance policy that is primarily set up for cash value. That is where most people go wrong. They're sold a policy that is not set up for high cash value. Step two, when the cash value is large enough, take loans against the policy and use them for opportunities. And then step three, see what the policy looks like if you pay the loan back, but also see what it looks like if you never pay that loan back at all. What do the numbers look like? What I would do with these three steps is ask your agent to show you these illustrations before you start the policy. This is so important. This lets you see the pros and cons up front, and it will really help buyer's remorse from occurring. Okay, let's look at why this is one of the safest places that your money can live. I remember an event I was at back in 2012. A lot of financial advisors were here, and some were giving presentations on why we should sell their products and services. And one of the presenters was showing a different product that he was saying, hey, do this, or you should give this to your clients. But the conversation of whole life insurance came up, and he owned whole life insurance himself. And he said, yeah, I'm really a fan of whole life insurance. Back in 2008, where a lot of my other investments lost money, my whole life insurance policy made money. You see, when we go through recessions, whole life insurance is a secure asset. While everyone else is worried about their money, people with whole life insurance have peace of mind because they know that their cash value is not going to go down in value. And guess what? Banks, corporations, and small businesses do the exact same thing. So your money keeps going up because you're investing in the insurance company that you purchase your policy with. So there's two types of life insurance companies. You have stock companies, and then you also have mutual companies. Now, personally, I prefer mutual companies because I've seen the best results from them. With a mutual life insurance company, the policyholders are considered the owners. What this means is that if there is a profit, those profits are distributed to the owners, which in this case are the policyholders. Now, the profits are distributed in the form of what is called a dividend. Here's how it works. When you get a whole life insurance policy, you will have a contractual guaranteed interest rate. This will depend on the insurance company and product you choose. Guaranteed rates range from 2% to 4.5%. Now, as a policyholder, you'll always have that guaranteed interest rate. However, you'll usually get a dividend on top of that. Say I have a policy with Mass Mutual, for example. Their 2025 dividend rate is 6.40%. If I have a policy that has a guaranteed rate of 3%, that's the minimum that I can get. But if the dividend rate is 6.40%, I get that instead. When you see the dividend interest rate for your policy, that is the total rate you will receive. Now, with all of that said, this is super, super important right here. The dividend rate is always a gross rate, meaning you're never going to see your money grow by whatever that dividend rate is. So if you have $10,000 in cash value and your dividend rate is 6.40%, you will not see your cash value grow by 6.4%. or $640. The reason why is because anytime I have a dividend rate applied to my policy, that rate is applied to my policy after backing out the cost of insurance and everything that comes with a life insurance policy. If I want to see the net returns, I want to ask for the annual yield. That's my year-to-year rate of return, or the internal rate of return. A question that comes up quite a bit here is if insurance companies are able to pay these dividends that are attractive, especially in a low interest rate environment, is what are they doing with their money? To give you a quick idea of where they invest their money, you'll see it diversified among several different areas. First, you'll see a small percentage of their assets in the stock market. You're likely going to see a lot of their money invested in bonds. It could be anywhere from 50% to as high as 80%. Some companies are even a little bit higher than that. What I will say though, is what I have seen really since the 1980s. Back then, bonds were very popular for insurance companies. They still are, but the bond allocation of their total portfolio has gradually decreased over time. So as that bond allocation has decreased, what I see insurance companies doing with their money instead is investing it in areas like mortgage notes, high-end commercial real estate. I've also seen insurance companies partially invest in or fully acquire other businesses. There are so many examples of insurance companies partially investing in, partially acquiring, or outright acquiring other businesses, which does help them generate more revenue. Now, insurance companies are also very, very good at predicting when we're going to die. So for example, when we get a life insurance policy, the insurance company is going to look at our health history, and when they review our medical records, they can almost pinpoint the age we're going to die. So how this helps the insurance company is because when we pay premiums, they can calculate exactly how long they're going to be able to hold on to those premiums, earn a return on that, which one allows them to pay the life insurance claim out, but also earn more money than what they have to pay out, which helps them establish a profitable business. Now, the last thing that I really like about whole life insurance is that it has always been a strong hedge against inflation. And people often look at whole life insurance as a core part of a diversified plan. If you were to look at dividend interest rates with most life insurance companies, you'll find that they move up and down with interest rates in the economy. So if you go back to the 1980s and early 90s, you would see double-digit dividend rates. Post 2008, when interest rates were very low, dividend rates were also very low, but you will see them move up and down with inflation, which is quite nice. Next, whole life insurance can be one of your most powerful retirement tools. A life insurance policy can give you a permission slip to spend other money more freely. For example, let's take person A and person B. Person A has no life insurance. They retire with a $1 million nest egg. They say, hey, I would really like to leave some money to my kids. So I've got other income, Social Security, maybe a pension. The $1 million nest egg, I'd prefer not to spend that. So they do their best to conserve it. This way, they can leave a legacy to their children. Let's take person B. Person B retires with the same $1 million, but they have a $1 million life insurance policy. So person B can now spend some or all of that $1 million nest egg because they still have the life insurance policy sitting on the back burner. It's a whole life policy, so it's going to last for their whole life. And when they die, that $1 million is paid income tax free. So this allows person B to enjoy their retirement more while they're alive because they know that the legacy piece is going to be taken care of through the life insurance benefit, which is also paid tax-free, which makes it even more powerful. Another way that I can use a whole life insurance policy during retirement is by drawing down the cash value. I can take withdrawals or loans from the cash value of my life insurance policy in order to supplement my income. Now, when I take loans, a lot of times people hear that and think, loan, you gotta pay it back, or you gotta pay the interest, right? You don't always have to pay that out of pocket. Whenever we are building one of these plans for someone where they want to take money from their life insurance policy, specifically the cash value for income, we're doing that through loans because that helps us take the money out tax-free. But we don't want to take too much out and cause a situation where we have to pay something back. So it's very easy to solve for this, where we can see exactly how much money we can draw against our policy, keep it tax-free, and ensure that I don't have to make any payments. because people don't want to do that during retirement. So life insurance, when it's set up the right way, is a tool that I could use to draw income on a tax-free basis during retirement, or I could leverage the death benefit as a permission slip to spend other money more freely and then leave the life insurance benefit to the next generation 100% income tax-free. Before you rush out to get a policy now, you have to know what to look out for. This is so important because some policies are not meant to benefit you. I remember years ago when I saw the first big whole life insurance policy sold. A doctor read the book called Becoming Your Own Banker by Nelson Nash. After the doctor read that book, he wanted a whole life insurance policy and he wanted it for the cash value. I remember the story. It was told that he walked into the conference room, threw the book on the conference table and said, I'm gonna put $100,000 per year into this product. The thing is, the two guys that sold him this policy, remember he was interested in cash value? His first year cash value was almost zero. And it took him more than 10 years just to get his money back or break even. That policy was set up for maximum commission. The agent that sold him that policy made about $85,000 in first year commission. That's before any renewals. And I remember the owner of the agency had several locations. He was praising the agent for that sale. He was so happy because of the amount of revenue that came in, but it didn't benefit the client. It wasn't what he wanted. The thing was, the doctor didn't know what to look for, and he didn't know what questions to ask the agent who was selling him that policy. The lesson is that it is so important to know how a policy can be structured. So here's how it works. When you pay money into a policy, you can actually choose where your money goes. So with a whole life insurance policy, there are two main areas that your money can go. The first is called your premium. Specifically, it is called the base premium. And the second is called your PUA, which stands for Paid Up Additions Rider. What does this mean? Well, the premium I like to refer to as the initial insurance expense, whereas the PUA rider, I like to call this a cash dump-in. The reason why I call these two an insurance expense and then a cash dump-in is because money that you pay toward the premium, especially in the first year, goes toward your death benefit, meaning it buys you life insurance, and you don't see it show up in cash value. Eventually, it builds cash value, but not upfront. Whereas money that I pay into this paid up additions rider, call it a cash dump, because it feels like I'm dumping money into cash value. I see it there immediately. So let's talk about Doc. So here we've got Doc. He paid $100,000 per year. So here he is, throws the book on the table and says, I got a lot of money here I'm gonna put into this whole life insurance policy. $100,000 per year. He was sold a policy where 100% of that $100,000 went toward the base premium and nothing toward PUAs. So as a result, what does his cash value look like? First year, zero. Not attractive at all. 10th year, what do you think it was? About $900,000. I think it was right around $930,000, if I recall correctly. After the 10th year, he stops paying. And if we look at the 15th year, it was worth about $1.1 million. So he did see a little bit of a gain, but that was by year 15 versus what he could have done. So this is where just having knowledge on what to do versus what not to do is so, so important. Alternatively, he could have done this. Had a policy, with a 10% base premium and a 90% PUA, and this would have gave him the following. So the cash value in the first year would not be zero, instead be very close to $90,000. By the 10th year, it's worth about 1.1, and then by the 15th year, it's worth about $1.3 million. So what's interesting about this is we've got the exact same insurance company with the exact same insurance product. He's paying the same dollar amount. We just see drastically different results. With this example, the agent in the first year, in terms of commission, $85,000. Whereas with this example, the commission in the first year, the agent makes $11,000. I know that because those are the exact rates I would get if I set the exact policy up that he bought these two different ways. Again, same company, same product, just structured differently. So here's what I would do. Be absolutely relentless about getting the right structure for your policy. I've seen way too many people just accept what their agent tells them as truth, but then later regret it. Now, some agents will get emotional and defensive here. I see this happen all the time. But if someone is getting emotional with you about a decision with your money, I would take a step back and ask why. Again, remember that it's your money, not the agent's. If you asked me to build a whole life insurance policy for you the same way that I build them for corporations, here's exactly what I would do. The first year cash value would be a minimum of 80%, but I would actually try to get it closer to 90%, would depend on the product. And then the break-even point would range somewhere between 3 to 5 years. If you've got some health issues, it might be year 6, but in most cases, the break-even should be somewhere between 3 to 5 years. A lot of times, people will ask an agent for that, and the agent comes back and says, well, you can't do that. And they'll hear things like the policy will mech. I would not just accept that. That is where you want to get a second opinion. So the thing is, just know that the agent is incentivized to sell you a policy that has less cash value up front. There's a million opinions on it, but that is how it works. It's just a fact of the matter. Okay. Once you understand what to look for, the next step is choosing the right life insurance company. Ask for proof of performance. Can your agent show you a life insurance policy with the company that he or she is recommending that has produced a net return on the cash value between 4 and 5%? Not dividend history, not an illustration that shows that, but a real policy that someone has bought several years ago. I would ask for this proof because the biggest form of buyer's remorse that occurs with whole life insurance is when people get a policy, they look at the illustration, and the numbers look fantastic over time. It's gonna grow and you'll be a millionaire down the road. But then the real results produce much, much less than that. That's overpromising and under-delivering. So I do like to see that proof of performance. All right, finally, here's how the wealthy use whole life insurance to basically create their own private banks. A client we've worked with for years named Tom is a real estate investor who has a portfolio valued over $60 million. Now, he's got some big policies that he heavily leverages for new property purchases and also making improvements on his existing properties. He uses his policies because getting to the money in his policies is way easier than getting money from a bank. That's what he enjoys the most. He requests a loan, it hits his bank account via direct deposit within a few days. He doesn't have monthly payments, and he can pay the loan back however and whenever he wants. When he takes a loan against his policies, it has no impact on his credit, there's no financial underwriting, and it's not stressful for him at all. It lets him move quickly, which is very, very important to him because his real estate portfolio is his business. And the best part about it is when he pulls money from his policies, he keeps getting dividends and interest on that full $1 million. So he's receiving constant compounding. And if he decides to pay that loan back, his cash value is fully restored. So this strategy gives you flexibility, freedom from banks and lenders, and the ability to fund some big projects without having to sell assets or give up control to a bank. I hope you enjoyed this video. If you did, I included another video here that provides more detail on how you can use a cash value life insurance policy like your own bank.